The retirement plan for SWAPA pilots can sometimes be confusing. IRS limits and plan documents dictate some of that complexity. This video will walk you through each area of what we refer to as the retirement schematic or pipe diagram. You can get a digital copy by clicking the link below or by visiting the SWAPA website and looking for it on the 401k committee page. Also, links to access each of these plan accounts mentioned throughout the video are available at the 401k committee page under Resources, Links to Plan. Let's begin. The company non-elective contribution, or NEC, is percent of eligible wages. Eligible wages include everything you normally associate as your pay, including trips flown, training, vacation, sick and OJI leave, and premium and JA pay. Eligible wages for the 401k and profit-sharing plans include taxable loss of license payments, however does not include non-taxable loss of license payments or sum per diem. The NEC is contributed to your SWAPA 401k account held at Schwab every regular pay period. The company's profit-sharing contribution is based on the annual profit-sharing rate. Traditionally, annual profit sharing is announced at the first Southwest rally of the year, which is usually in February. It's a function of the company's adjusted net profits divided by the number of eligible employees. The company has chosen Empower as the administrator for the profit-sharing account. This valve shows how qualified NEC money gets shut off once you hit the IRS 401A-17 limit on eligible compensation. Only NEC money on earnings up to this limit can go into your 401k because it's a qualified retirement plan. This valve is identical to the one on the left and serves the same purpose of shutting off qualified profit-sharing money on earnings over and above the IRS 401A-17 limit. Like the NEC, profit sharing on income above this limit can't go into the profit-sharing plan because it's a qualified account like our 401k. This green box represents your payroll deduction. You elect a percentage of wages to contribute, either Roth, which means after-tax dollars, pre-tax dollars, or a combination of both via the Schwab website. Your contributions are limited by the IRS 402G elective deferral limit. Once you hit that amount, your personal contributions are shut off. Qualified money from you, the company NEC, and profit sharing all count towards the IRS 415C contribution limit. This main tank is filled first come, first served, meaning one source can be crowded out by other sources. It's important to remember this, especially if you want to contribute Roth, because only pilot contributions can be Roth, while all company contributions, NEC and profit sharing, have to be before tax monies. If you want to max out your Roth, you have to make sure you elect a large enough pilot contribution percentage so that your money gets into the tank before it's full of company NEC money. Once this tank is full, any additional NEC or profit-sharing monies coming in will spill over as non-qualified excess money or be paid in cash. We'll get to that in a minute, but first, back to pilot contributions. If you are at least 50 or will be by the end of the year, the IRS allows you to make catch-up contributions to your 401k. This is known as the IRS 414V catch-up limit. If you are turning age 60, 61, 62, or 63 this year, then you can also make super catch-up contributions to your 401k. Picture these catch-up contributions going into two qualified auxiliary tanks. These monies do not count against the 415C limit, so older participants can save additional money in qualified plan contributions. Here's the catch. Any catch-up or super catch-up money has to come from you, not the company. So that's the end of qualified retirement savings. If you want to get some additional tax-deferred savings, you may have access to as many as 3 other non-qualified plans. We'll go over 2 of these now. The third, Top Hat, is beyond the scope of this video. Remember that income over the IRS 401A-17 limit isn't eligible for qualified plan NEC or profit sharing, but we're still entitled to that additional NEC and profit sharing money. Each year during the fall non-qualified plans enrollment change window, one can choose whether they want the additional money to go into the non-qualified 401A-17 plan for next year or make no election and receive the extra dollars as taxable cash. Contributions to this plan are deposited into a rabbi trust held by the company. The rabbi trust has some protections for us, but our money could still be taken by creditors if the company were to declare bankruptcy or suffer insolvency. So if you're worried about Southwest facing something like that before you retire, enrolling in our non-qual plans probably isn't a good idea for you. This plan, along with the other 2 non-qualified plans, is accessible via the Empower website. If you make the election to defer into this plan, the election is for both your NEC and profit sharing. Non-qualified spillover money from the qualified tank is either paid as taxable cash or deposited into your non-qualified 415 excess benefit plan. Like the 401(a)(17) plan, one can choose to contribute to the 415 excess benefit plan during the fall non-qualified plan's enrollment change window, or make no election and receive the spillover as taxable cash. The 415 excess benefit plan is identical to the 401(a)(17) plan in structure and protections. Same rabbi trust, same investment options. The only difference between the two plans is where the non-qualified contributions come from. This plan is funded by money that spills over the 415C contribution limit, while the 401(a)(17) plan comes from contributions from wages above the 401(a)(17) income limit. One last thing to cover. Our CBA lets us choose a set profit sharing deferral percentage, 3.5%, 7%, or full, that will be directed to the profit sharing plan. Many of us want to make our own individual choice, but the IRS requires the choice to be for all. So the membership votes during each fall election, and the most popular choice applies to all of us. It's a topic SWAPA educates on every August, so look for more information then. Since profit sharing funds after the end of the calendar year, profit sharing is normally the last money to flow into the qualified tank. Remember that profit sharing is paid in March of the next calendar year. If the tank is full of NEC and/or pilot contributions at that time, profit sharing spills over and is immediately paid in cash if you have not elected a non-qualified plan. Hopefully this video has given you a better idea of how our plans work together. If you have any additional questions, call SWAPA. Thanks for watching.